Hi guys, this is Vishwas here and welcome to Gullak's another podcast. And today's topic is extremely important and very curious also for a lot of retail investors. SIP versus lump sum, which one is better, which one should you use in certain conditions is a thing which a lot of people are curious about. And at times we are at a very distinct situations in our lives with regards to our money because sometimes we get bulk of money from, let's say, a particular property sale, ESOPs or something else. And one is obviously our monthly income, which is, let's say, our in-hand salaries or business income, whatever we are generating. uh, and some people have a lot of myths and beliefs that some people believe lump sum is better, some people believe SIP is better in some other way. So we have Mr. Vivek Sharma with us. He's a head of investments at Gullak, and he has had over 2 decades of experience in investing. So we'll today ask him from his experience, his learnings, and his research as to which one is fairly better. Hi Vivek.
Hi Vishwas.
Right. So straight away, the very first question, SIP versus lump sum, which one is better? Your overall thoughts, we'll obviously deep dive into, each nuance and aspects. But overall, if you can give us an overview of SIP versus lump sum, which one is better?
Okay. So as you rightly pointed out, this is a very, very important topic, and I keep getting a lot of questions related to this specific thing only, कि whether to do SIP or lump sum, and no matter where markets are. मार्केट्स बहुत ऊपर हैं या मार्केट्स एकदम बेयर टेरिटरी में चले जाते हैं या फिर फ्लैटिश रहते हैं. No matter what markets are doing, I think this is a common question, common doubt amongst investors that which is the one that would yield higher returns over long run, whether it's SIP or lump sum. And the answer in my mind is pretty clear. And before I take you to the answer, I just want to say that in stock market, obviously you have a lot of data, and stock market is more a game of probability rather than a certainty, right? At no point you are really certain ki what's going to happen. I think 2-3 years back there was a lot of positivity in stock markets that India is the next growth story and next 10 years are going to be awesome, and the equity returns are going to be awesome over next 10 years. I really don't doubt it even now, but because of the last 1 year returns, a lot of investors have started doubting it. Right. So over 10 years, there's a good certainty that it will come, but it's not 100% certain. So the point I'm trying to make is that it's always a game of probability. Stock market, there's some probability. You could assign some higher probability or lower probability to the returns, but it's always a game of probability. And if you look at markets in such a way, I think it will help you make those decisions, either this decision or any other decision. Now, having said that, now what we would do is we'll look at the historical data.
Okay.
We'll look at whatever past 15-20 years of historical data that is available, and then we'll see which one is better. That's what we have seen in Indian markets. So I'll tell you what we did first. So what we did is we took historical data, monthly data, and then we saw for each month, let's say starting in Jan 2000, if somebody were to do lump sum versus somebody were to break down that whole lump sum in say 3 equal parts, and on the 1st of Jan, 1st of Feb, 1st of March, they divided and invested, versus invest everything on 1st of Jan. And then we saw the returns 12 months later. What are the returns, right? And this we did for all the months. So starting from January, and then we did for February, March. That's the rolling monthly analysis we did over past about 25 years or so. And the results showed us that lump sum is better. And the reason is also, I think, pretty intuitive, because stock markets over long run, they tend to just drift upwards only. Obviously, you have your corrections and your peaks, all of those things, but over long run, stock markets are trending upwards, and that's why you see that the probabilities are on your side if you were to go long. And doing lump sum is just you're taking that bet earlier. Versus dividing your money and dividing that bet in next 3 parts, you're taking that bet of going long earlier. So the probability is in your favor. It's not certain that it will work, but the probabilities, and the probabilities are pretty decent actually. roughly about two-thirds of the times, you would end up better if you do lump sum. But then there's another one-third where you are worse off,
Right.
which means in those one-third of the times, actually SIP works better.
Right.
And I think we all know that if markets were correct, then obviously SIP would work better. But if markets don't correct and they keep going up, then lump sum
Lump sum will work better.
So that's what the data tells us really, that lump sum works better. And this is, we have done this analysis for India because we couldn't find any such research. But then we looked at the other research which was done in other countries like US, UK, Australia, Japan. And we looked at those kind of research reports, and in all the research reports, the conclusion is same, that lump sum works better, and roughly it's about 70%, 30%, roughly around those levels only. Ki two-thirds of the time
Right.
lump sum makes more sense, and one-third of the time
SIP makes more
So
sense.
that's what the data tells us.
Right. And very interesting. But, to play a devil's advocate here on the lump sum part specifically, on lump sum, there are two conditions that I think you're going for. One is that you obviously have a good amount of capital that needs to be allocated
Yeah.
upfront with you,
Yeah.
right? Which is not always the case. And now the case of argument which is made for SIPs is that you are sort of going away from the respect of being humble in terms of not timing the markets. Whereas in lump sum, a lot of people, despite this whatever the study shows, is that when it comes to lump sum investing, people are usually trying to time the bottom, or
Yeah.
let's say time a particular time in the market where I'll just deploy lump sum.
Yeah.
So there is that aspect also to it. So what is your take on that?
So my take is again quite clear in this. So if somebody is trying to time the market, then what is happening in that case is you are delaying your investments into the market. If at this point of time I get some windfall, and that's the point I believe it's the lowest point and I want to invest right now, then you are not necessarily trying to, or you're trying to time the market, but you're not sitting outside the market. You got the opportunity at that point, or usi time aapke paas paisa mila and you invested. So then it's okay. But if you are trying to time the market and you have to wait it out, you feel that currently market is not at good level, and you wait it out for a couple of months, 3 months, 6 months, it could be 1 year or even longer, right? And then you invest. So what happens is you're waiting out. First of all, timing the market, it's very, very tough. We all know over long run, not only retail investors, but even mutual fund managers, they don't do a very good job of timing the market, right? So it's just a coin toss really.
Right.
And secondly, what's happening is you're delaying your investments into the market. So let's say if you waited for 6 months or 1 year, you're just delaying and you're missing out on the opportunities during that time. And as I said, markets over long run, they keep trending upwards only.
Right.
So most likely, see, you might end up, again, it's a game of probability, you might end up being lucky, and in 3 months, 6 months, you got a very good correction and you invested. But that's just because of luck. That's very, very few people can really time the market.
Right.
And you're just delaying your investments in that case.
Got it.
And I've seen a lot of studies which show some sort of SIPs, some methodology, some smart SIP, they call it smart SIP or something, they give it some fancy name. But most of them, in fact all of them, whatever I have seen either on YouTube or mostly on YouTube, that they don't work. These smart SIPs really, which try to time the market, they don't
Enhanced
really,
SIPs basically.
Enhanced SIPs also.
Yeah.
They don't really work as well. And I'll tell you why they don't work. What most of them have done is, let's say you have a coin, okay, you toss that coin 10 times.
Right.
And you get say 7 heads and 3 tails. So does it mean that you found a coin which is likely to give you 70% heads versus only 30% tail? It really does not mean that, because you just toss that coin 10 times. If you do it 100 or best is 1000 times, then you will get very close to 50-50, right? So the point I'm trying to make here is, if you have only few test cases, right, earlier, using that you really cannot conclude anything meaningful. So most of these enhanced SIPs, smart SIPs, what they have done is they have done some sort of back testing, but that back testing is not good enough. It does not give you enough number of occurrences, enough number of experiments to really conclude anything meaningful.
Right.
And that's why they don't really make sense at all. Really.
Yeah.
So yeah, that's what my point is, that if you are delaying your investments because of timing the market, again, it will not work.
Right.
It might work due to you being lucky, but it's not a systematic way of investing really.
And an interesting point, I think, on enhanced SIPs is that the invention of SIPs was done so that you can avoid timing the market, sort of. And this enhanced SIPs is actually doing that same thing. You are actually again trying to time the markets with those enhanced SIPs.
Yeah.
So, right. So, very interestingly, like you said, that out of 2/3 of the time, lump sum basically wins, and on 1/3 of the case, SIP wins. Now, like the point which I also raised earlier is that because we declared a clear winner, that lump sum is sort of that winner. But what is then the case to be made for SIPs, in the sense that we usually don't have lump sums. We are operating from a standpoint of monthly incomes, and that is where SIPs also sort of fits in, right? So what is your take on that?
So the take is very clear, that invest when you have money. In case you are earning, most of the people following here this channel would be on a monthly salary, right? They get their monthly salaries, they spend on certain needs and wants and save something and then invest that. So as soon as you have money, you invest. I'm not saying put everything into stock markets, equities. Obviously, you do your risk profiling, you figure out your asset allocation, and depending on that, let's say if you feel that you want to put 70% in equity, rest 30% in debt. So based on your asset allocation, you keep putting money in 70-30 proportion. And obviously rebalance that every year. Rebalancing, again, we can talk about it. It's a very nice way of really timing the market, and we can talk about that. But that's the whole point, that invest as soon as you have money. In case of your monthly salary, you don't really have any other choice. You get monthly paychecks and you invest on a monthly basis. Now, there is one point, however, I'd like to clarify in this. Lump sum, we know data tells us it works best. But let's just talk about investor profiles also, that a very aggressive investor and a very conservative investor. Now, for a very aggressive investor who is willing to take that kind of risk, and he would most likely be okay if he in the short run loses. For them, definitely lump sum would make sense. The data is also in your favor, and you have that kind of risk appetite also. But in case of a conservative investor, I would really suggest that look at the SIP, because a very conservative investor really can't sleep well if they have taken extra risk. And the biggest risk in their mind at least, is that what if the market falls? Obviously, the probability is still in your favor that it will go up, but even that 30% chance of markets falling, somehow it doesn't gel well with a conservative investor. So for conservative investors, what I almost always advise is you break it down, whatever lump sum you have, break it down into 3 equal parts, 6 equal parts, and then invest. So that usually works. Psychologically, it works better for a conservative investor.
Right, because psychologically what you're doing with SIPs is, even if you have lump sum, is that supposedly you invested, let's say you have 10 lakh rupees or 12 lakh rupees, you did a 1 lakh SIP every month. Now that 1 lakh could rise or fall, but when the moment you invest your next 1 lakh, it will sort of average out and will keep you a little calm,
exactly.
Even if drawdowns are coming.
Exactly. So for conservative investors, that definitely makes sense. There's one more point actually in the research that we did, that instead of 3 months, what if you break it down into 6 months, right? Which is a better thing to do, whether it's 3 months or 6 months. Now again, coming back to the original point, that invest when you have money. The sooner you get into the market, the better it is for you. So if you look at it that ways, then the answer would be clear, that in 3 months you are investing in your money within 3 months. So that is likely to give you better results than 6 months, because you are putting your money, obviously spreading it out over 6 months. So again, if you put your money earlier in 3 months versus 6 months, 3 months works slightly better than putting in over 6 months.
Got it. So we have gotten a roadmaps, so far, Vivek, for SIPs, that if you But let's say if somebody was receiving a big lump sum amount in their life, and this could be either through their ESOP liquidations, their property sale although generally goes into a property only, but still let's say we can count that, or some other form of cash that they're receiving, which let's say they'll not need it for let's say next maybe 5-10 years, right? It's a pool which either could have gotten reinvested into maybe FDs or property or somewhere else. But today they decide that they want to put this into equity because they have a horizon of next 5-10 years. How should they be ideally investing that lump sum amount?
So again, I think the first thing that they have to look at is their existing portfolio, right? Existing portfolio, and obviously do your risk profiling and see whether your existing portfolio actually matches with what the risk profiling has to say or not. That is one thing. And secondly, your overall portfolio, that's what you have to, that's the roadmap, that your overall portfolio has to be more or less in line with what your risk profile is telling. So if you are a conservative investor and you also want to make very high returns, you have to take risk. Even if you take risk during the good times, obviously you won't feel it, you'll make money, but as soon as the bad time comes, the market start correcting, you'll be very uneasy, and you'll be actually most likely what happens in these kind of cases is कि you almost always exit at the bottom. जैसे correction start होता है, you start feeling uneasy and you exit and you book your losses. That's why your portfolio has to be aligned with your risk profile, and that's what you will need to do, irrespective of whether you got your money from property or ESOPs or anywhere else. Look at your risk profile, look at your goals. Again, as you said, that if you don't have any short-term goal and you can comfortably invest that money for 10 years, and looking at your risk profile, you can decide your asset allocation, and based on your asset allocation, you can put your money. Now, whether to put that money again all at one go or using SIPs, it's just a matter of your risk profile, that how much risk, how much aggressive you want to be. If you are okay in being aggressive, I see many investors who are okay in being aggressive and they put all their money at one go. Whereas some others want to split it over 3 months or 6 months. But see, most important is making a plan and sticking to it. What most investors do is, because they don't have the clear answer, they keep just waiting it out. They just wait it out for very, very long, and then you miss the opportunity really. So that's what you should not do. Make a plan, ki theek hai, I'll invest in 3 months or 6 months. These are not very big really. Over long run, these are not very big decisions, frankly. The biggest decision is whether how soon you can enter the market. It's 3 months, 6 months, not that big a difference. Even lump sum versus 6 months, it's not really a very big difference if you are investing over 10 years. So over 10 years, a difference of 6 months, it's not going to make much of a difference really. So, but as I said, most important is make a plan, stick to it, and then go ahead and invest.
Correct. And there are two more, questions that I have with regards to lump sum is that number one would be, is small and mid caps a very good option? Because if somebody's, let's say, has a horizon of 5-10 years, and largely in India, because eventually these small and mid-sized companies will eventually become mid caps or large caps. And drawdowns, obviously, we know is very high in terms of volatility. You can get a 15, 20, 25, 30% kind of a volatile scenario in this sort of a investment profile. But returns also are pretty much very high when it stabilizes and when it comes to its full recovery and everything. So one is that, would you advise somebody to go in small and large mid cap, even though if they're a conservative investor, given that they have the horizon of 5-10 years? Number two would be, what could be a case made for products like PMS or AIFs, if somebody has that big lump sum amount and they have a horizon like the same 5-10 years, because some people might have this choice bias, a confusion. They also have a PMS in front of them, they have 50 lakhs or 1 crore type of an investment, and they also can maybe invest in, because ultimately you're going either to a PMS or a small and large mid cap to generate alpha returns, right? Beyond what your traditional mutual funds or your certified financial planner would give you. So wanted to have your thoughts on that.
Okay. So the first question about large, mid and small caps, I feel if you really, there are two ways to go about it. One is you invest in either flexi cap or multi cap and let the fund manager distribute it, and that's
Right.
a pretty decent way of doing it if you don't want to do it on your own, because
Yeah, very
obviously-
no nonsense and very.
yeah. So that is one very simplistic and very good approach. Or another approach is if you yourself want to do it, or if you are working with a financial advisor who is helping you out, then obviously you can invest in large, mid and small divided. And I think conservative investors can also invest in mid and small cap. Obviously the allocation to small and mid would be lower than large caps, and aggressive investors would want to allocate larger proportion to mid and small caps. But obviously it depends a lot on the valuations really,
Right.
right, at what time you are investing. I think 3-4 years back mid and small cap were at valuation of the PE ratio was I think below 20 also, and that time nobody was really paying attention. Had somebody invested at that time, he would have made really huge returns, and people did make very good returns. At this stage obviously I think large, mid and small, there are obviously some pockets of very good opportunities in mid and small, but as an index obviously the large cap gives you more comfort than mid and small. But yeah, overall, see, if you're working with a financial advisor, you have your own interest, and you do your own research, then you can obviously put, depending on your risk profile, put divided between large, mid and small. One thing that I was just doing some sort of analysis again at the index level, that mid caps give you the best risk adjusted returns. In small cap actually the returns are slightly lower than mid cap, but the risk is higher.
Right.
And this is over last 20 years, and again this is purely on at the index level.
Yeah.
Then there are active mutual funds, and it depends on your fund manager's capability, his skill set, what he is able to do apart from the index.
Even I sort of did one study with one of the CIOs of large and small mid cap. Is that in post 2008 global financial crisis in India, in the last 17 years, small and mid cap has beaten large cap by a very huge margin. Yeah.
Yeah, that
But yes, obviously the time period is really important.
And in those kind of studies, I think what's more important is your that's a point in time, right? That from one point to another.
Right.
And the best way to actually do it is obviously if you take into account the rolling analysis, rolling 10-year or rolling 15-year, rolling 3 years. That gives you the broader range that this is the best case scenario, this is the worst case scenario, and this is the average.
Right.
So that kind of analysis. But yeah, those are my thoughts regarding large, mid and small. And yeah.
Right. And when it comes to, let's say, PMS, or let's say if somebody wants to explore PMS with the lump sum investment, then how would you suggest them they go about it?
See, there are a couple of things to think about when you want to explore PMS or even AIF. In PMS, it's 50, the minimum ticket size is 50 lakhs, in AIF it will be 1 crore. One thing is how large your portfolio is.
Right.
So what I would say is PMS, if your portfolio is anywhere below 2.5 crore in that range, then you will be allocating much larger than 20-25%. So if it is, let's say, 1 crore, then you are effectively putting 50% of your money in one fund, which becomes risky. Right. So about 2.5-3 crore is the broader range where you can start looking at PMS, and for AIF it has to be maybe about 4 to 5 crore. So that's the portfolio size. Secondly, maybe at times I've seen investors miss that they see they don't see post-tax returns. So I think in any sort of investments, always look at your post-tax, how much you are making, because one of the biggest advantages of mutual fund is obviously your taxes. You don't need to pay taxes on unrealized gains, and even though your fund manager is churning, even then, if you're holding those units, you don't need to pay those taxes unless you keep holding it for 10 years and you get compounding on that profit, right? So that is, I think, one very big structural advantage in mutual funds. But having said that, there are few PMSs obviously who have done a very good job even at a post-tax basis. They've done a pretty good job. I think one should look at PMS AIF only if there's some differentiated offering really. If you find a differentiated offering which is really uncorrelated with what you are currently holding through mutual funds, then by all means, if your portfolio size also allows, then look at those. But otherwise, it's not really required. Mutual funds, you have all kind of mutual funds.
Right.
So if you don't see a differentiated offering, then just purely for the returns, I don't think
Right.
it makes sense.
Got it. I think this has summed up, our SIP versus lump sum very nicely. I think viewers, you must have gotten a really insightful session with regards to SIP versus lump sum, and I'm sure there must be a lot of questions you might have. Do ask us in the comments, and we'll reply to them as much as possible. And let us know any other further topics that you are really confused about for your investment decisions. We'll pick those topics up. Thank you so much for tuning into Good Luck Podcast today. Thank you, Vivek sir, for
Thank you,
joining
Vishwa.
us.